Okay, so that's also wonderful for putting in recommendation. So good morning, friends, and welcome to another wonderful episode of Saturday morning sessions. So as we all know that people like all our members from across India, like whether it's Ahmedabad, Bangalore, Jodhpur, Kerala. I'm from West Bengal. So people from across India we have joined to share our insights and thoughts on the changes that have been implemented on the basis of the recommendation of the 53rd GST Council meeting. So we have none other than Deepak Jainji, who is from Bangalore, and he's going to take us through the remaining implementations that are to be discussed. So we have already introduced Deepak Ji in the last session. So we would just now like to hand over the mic to him. So Deepak Ji, over to you.
Thank you, Arupji. I remember when we started these sessions earlier, we had planned to start with section 16, and then we
Yes.
landed up with circulars, and then we are landing up with notifications. So that's the beauty of the law, that it is so very dynamic that you can't just stick to one topic, and you have to keep really abreast and be ready with any topic what we get.
Right.
My privilege, and I'm really thankful that I got the opportunity to discuss the last session, continuing this session on the important notifications and circulars. So we'll cover the important changes what has happened in the notifications which impacts us. Procedural aspects like change in registrations, Aadhaar authentication, verification of the person, those things are procedural. So we'll not discuss on that. If something is there, we'll discuss on those aspects at the end of the session. But we'll try to discuss those sessions which have a technical impact, which we could all discuss on that. So I'll bring up the notification and the relevant circulars which is brought in, which is trying to clarify the notification, the aspect of the change in the rules, and we'll see how what are the things which still those notifications and circulars are not trying to cover. Okay. So good morning, one and all. Let's start the session now.
Deepak, we have covered all the circulars last week.
No, we have not covered all the circulars.
Okay,
We have covered 3 circulars. We'll be covering a few others today.
done. Okay.
So we'll start with the discussion on the valuation aspect of corporate guarantee, wherein now the valuation of 22 was already brought in on 26th October 23, and now they're trying to fine tune it with few smaller or nicer issues. I've reproduced the rule which is after the amendment. So the amended portion is highlighted, which reads that notwithstanding anything what is contained in Rule 1, that is Sub-Rule 28.1, the value of supply of services by a supplier to a recipient who is a related person located in India by way of providing corporate guarantee to any banking company or financial institution on behalf of the said recipient shall be deemed to be 1% of the amount of such guarantee offered per annum, or the actual consideration, whichever is higher. So what they have brought in additionally from the Rule 22, and this is a retrospective amendment effective from 26th October itself. They are saying that the recipient should be located in India only then this rule will apply, and the quantum or the time period. Earlier, they've just said 1% of the corporate guarantee, and once you issue corporate guarantee this year, it will appear in your balance sheet year on year. Correct? So then what happens was the question whether you will pay 1% for the first year when you give the corporate guarantee, but in the next year's balance sheet also it appears. What do you do there? That was a question. So now they have clarified that it will be 1% of the amount of guarantee offered per annum. Okay. So is it per annum in the sense that as long as the corporate guarantee continues, or is it that still first year itself and leave for the next year? Can we say that the time of supply is triggered only in the first year, So it will not appear in the subsequent years. That is still a clarificatory thing which we will have to discuss. And then they brought a proviso to this saying that where the recipient is eligible for full input tax credit, the value declared in the invoice shall be deemed to be the value of said supply of services. So now we've seen wherever import of services there or wherever related parties are there, they're trying to bring in this provision in all the places wherein they're saying that when you are eligible to claim the credit, the invoice which is raised between the supplier and recipient will be treated as the value. So it's a deemed valuation wherein any value where the recipient is eligible to claim the input tax credit, then the value what is declared in the invoice is the value for a consideration. Now, proceeding further, we'll see the relevant circular and then we'll come to the discussion part of it. The circular which is issued is Circular 225, which says that the corporate guarantee was taxable even before introduction of 28.2. So one interpretation could have been that since you're bringing in 28.2 now, from October 23, we will treat that before this, there was no valuation mechanism. They're clarifying no, before the October 23 also, it was there. The valuation is not a new valuation. It's only clarificatory in nature now. So for the period prior to October 2023, you will have to refer back to the old rule 28 and the valuation will still apply. Second clarification, what that bringing in is corporate guarantee is a service provided for issuance of the guarantee and full value of the CG corporate guarantee is taxable irrespective of the drawdown. So if a company is given a guarantee for worth 1 crore rupees and the subsidiary is utilizing say only 60 lakh rupees, we would always contend that since I'm utilizing only 60 lakh rupees, even if you want to value it, even if you want to tax it, you tax it on how much is the loan I've taken. Why are you taxing it on the whole guarantee value itself? The circular is now stating that no, it will be taxable on the whole value because the assurance is given by the holding company for the value of the corporate guarantees. On the whole value, it will be taxable and not on the amount of loan which is disbursed. Then the third clarification is credit of GST on corporate guarantee is available to the recipient who is a registered person regardless of the date of disbursement of the loan. So as soon as the corporate guarantee is given, that will be treated as the date is what the circular is trying to bring in. Another clarification is the GST on corporate guarantee is applicable on issuance, reissuance, or renewal of corporate guarantee. So any kind of issuance, reissuance, even on that aspect, the circular wants to bring in the taxability. Then says GST on corporate guarantee is applicable even when foreign entity provides corporate guarantee to the related party in India. So they're trying to say when you have a foreign holding company and giving a guarantee to the Indian company, so the Indian subsidiary will have to pay the reverse charge on this corporate guarantee, treating it as an import of service. Now, when we have this point, we'll have to see that we have another circular 210, which says that in case of related party transactions, when there is an import of service, nil value is also possible when you don't raise an invoice. So they have brought in a clarity in 210 saying that when you have any import of services and if you have not raised any invoice, then nil will be considered as a value. So will that nil value be, can I refer that circular and say that even this scenario, it should be treated that when I don't raise an invoice, nil is the value, so no GST payable. That is one thing which we have to see. Then they're saying 1% per annum, and they've categorically saying that if you give a corporate guarantee for 5 years, then GST is payable on 5% in the year of issuance itself. And if corporate guarantee is for 1 year and renewed year on year, then it will be payable for each of those 5 years. So this is on the time period saying that it is per corporate guarantee is on per annum basis. Then considering that amendment in 28.2 is applicable only when the recipient is located in India, the circular clarifies that recipient is will not apply when the recipient is located outside India. So what does it mean? A subsidiary is outside India. The company, the holding company is in India. It is providing a corporate guarantee to a subsidiary outside India. So will it be treated as an export of service? Ideally, it should be treated as an export of service, but circular says that for export of services, this rule will not apply. So will we fall back to the rule 28.1 itself and the valuation will not be 1%? According to me, then the valuation will be the open book value, or it could be the cost plus 10%. Those other rules will kick in. So the points for discussion basis this is, firstly, whether the amendment applies to import of services and services provide. Firstly, the amendment itself provides that it is applicable to import of service and
Deepak, you're not audible. Is it for everyone or for me?
Yes, sir. Everyone.
Everyone, right?
Okay.
Connection lost.
Yeah, I think he would join back. So till he comes, let's look at the points. So couple of places I feel the circular has gone beyond its jurisdiction.
Correct, sir. Correct.
So if a circular cannot say for domestic transactions it's applicable, but for export transactions it would not be treated as export of services. There is no rationale in making that statement, unless otherwise if someone wants to say that why that would be valid.
Correct. Correct.
The next thing is on the term loans. So if the term loan period is 5 years, the circular intend to pay the corporate guarantee commission for 5 years, which is also not right, because I've just given let's say 5 crores and every year it is reducing 5 crores, 4 crores, 3 crores. So paying 5 crores for year over year, it doesn't seems to be valid, and the valuation is for the guarantee, and the
Correct.
guarantee has been provided in the year 1. Supply is consideration and supply is determined at that point in time. It's a continuous supply of service, and the value is determined in the first year. I don't find logic to do for the subsequent years. I agree my guarantee continues. So that is why I have paid 5 crores for that guarantee. So which is also challengeable in my view.
I also feel that unless there is an amendment in continuous supply of services, there is no way that corporate guarantee can be treated as continuous supply with Schedule 1.
Correct. Because now we are now saying that this is the valuation for this supply. I am giving guarantee only one time. So value is determined, everything is done. So subsequent years, jurisdiction to levy tax wouldn't be there, is my view.
Effectively, we are stating that there is only one taxable event.
Just to add, in case the intercompany arrangement provides for some cross charge from overseas, and they are mentioning that the cross charge could be per annum, then the situation could change. But I agree that wherever it is a free of cost kind of a supply, the argument which the you all are taking should be valid, that it is one time and it can't be every year.
Deepak, you are back. Over to you.
So the time period is the issue here, wherein say if you, because when you give a corporate guarantee, the time limit generally would be that it is valid for a period of 3 years, and then you'll have to take another corporate guarantee or this will lapse. but primarily it is a one-time activity which I'm doing and not a continuous supply, I would say, because once I give a guarantee, I will have to hold it on till the period I've given a corporate guarantee. So I've issued once, but the validity of it remains for the period what I've given it. So in that aspect, this has to be challenged. I think the earlier circular 204 also has been challenged before the Punjab High Court. So this may also lead to a definitely a challenge there. Now, on this aspect of treating or not treating this when there is a export, when you're giving this for a subsidiary outside India, right? So then what valuation will apply when the rules clearly says that 22 will not apply? So what should be the value in a practical scenario when I give it for a subsidiary outside India?
Deepak, is the rule not saying not applicable, or the circular is saying not applicable?
The rule specifically says it applies to a recipient in India. So the rule itself is clearly a marking here.
If that is what it is saying, and which is the valuation rule,
Right.
now if I go with 27 or 28 first part, wouldn't this be the open market value?
If I go to 28(1), what will be my open market value?
Whatever defined in 28(2) for a domestic, wouldn't this be the open market value?
But if you go to 28(1), you will not fall under 28(2). The open market value is theoretically defined under 28(2).
Correct.
So for 28(1), I will have to see what is the bank rate then. A comparable bank rate would be a better comparison than getting into a theoretical 28(2).
How would the bank rate define? Because my guarantee risk is same independent of the lending rate, whether the lending rate is at 15% or 10%, the risk that I am carrying by giving the guarantee is the same.
Correct, but a comparison of 22 wouldn't be correct, is what I'm trying to say, because 22 anyways is an artificial rate of 1% which they're trying to bring in.
No,
So my
that has been
open market
defined
value-
as the open market value. Can that not be adopted for export transactions?
One point which I wanted to raise here, if you can see in some of the matter, in some of the circular, they have said that if there is an export of services to the foreign subsidiary and there is no consideration involved, it will be treated as a nil consideration and there will be no taxation. I think they have tried to bring this concept into this corporate guarantee also, and they are saying that if there is no consideration involved, so there will be no taxation on it, considering because it's a reverse tax. I mean, they have to pay the tax and they have to take the credit itself. And only when there is an actual consideration involved, it will get taxable. So that is why I think they, in this rule, they have made these changes and saying that if this rule of artificial valuation will apply only when it is located in India.
Ramandeep sir, you are raised hand.
Yes,
You
sir.
Yes, sir.
Sir, I was just trying to say that thing which I said. This is applicable. Probably they have tried to do something that only when actual consideration is involved in the foreign transaction, then only it will get taxed. In case when there is no actual consideration is involved, it will go away, considering the neutrality effect.
No, but if you see the proviso to Rule 28, it doesn't talk about nil valuation. So that's what was my other question, that can we say that whatever is said in other provisions, can we consider nil also in this provision? Because in this provision, they've said only when you raise an invoice and you're eligible to claim the credit, that invoice will be treated as a proper value. But they have not said when invoice is not raised, nil will also be a value. neither in the rule and neither in the circular. So based on other provisions, wherever they've said you have to import a service, say in those cases of secondment of employees, they've said that, okay, after Northern operating and everything, now they've said that, yes, nil will also be treated as a value. But you can't, bring in that circular to this aspect, because in this aspect, they have not said that nil is also a value.
No, but that circular which was issued in context of ISD and cross charge, why can't we apply that logic of nil value here? Because that also is interpreting the provisions of Rule 28 only, and the proviso to 28.2 is similar to proviso to 28.1, second proviso. So the same rationale should apply to both the provisos because the language is more or less same.
Correct. So that is my question. I feel that it cannot be. What would be your point to say that yes, it can be applied here? And other point to counter is, why have they not specifically said in this circular?
To my mind, the language of both the provisos is same. So the earlier circular can be applied as far as the nil value is concerned.
Okay.
Is there anything like we have to relate to the earlier circular, I mean, the recent circular on import of services? Because if we read it as a standalone, it talks about only the related party located only in India, restricting it to 28.2. If that being the, and it's specifically only for corporate guarantee.
जतिन जी आप कुछ बोलना चाहते हैं?
See, I just wanted to add, don't rely on circular. I would I would articulate the same argument in a different manner to say that I'm not relying on circular. First of all, the argument has to be nil value is also a value. Whether it is a clause 1 or whether it is a clause 2, nil value is also value. That is why the zero value is to be treated as this market value of this supply, full value. Now, as far as circular is concerned, I will believe, or I would argue, that circular is supporting my contention. I'm not applying circular. I'm saying this is what my contention, and my contention is supported by the circular in a similar proof. I'm just articulating the things in a different manner. That's it. Because we all know that circular is not the law. The only thing is to say is when those two similar provisions are there, and this is what my argument, and my argument is supported by the CBIC's views, at least. I think this way it can be articulated.
Yes, sir.
Right.
And first of all, another aspect would be have to be seen whether corporate guarantee itself is a service or not. Well, there is a stay which is stayed by the Delhi High Court in Sterlite Power Transmission case. And when the stay is there, in spite of that, the government has come up with amendment in the rule, and our rule was there. So the circular was challenged, and whether it's a corporate guarantee is a service itself or not was already challenged. And it is, they've said that, okay, keep it on stay and we will discuss in detail. So in that scenario, would one have to suggest a client saying that you pay the taxes? Because of course, if it is within India, the recipient can claim the credit. But in a aggressive view, what would one do when this question of corporate guarantee itself is being challenged? Jatin sir, what do you feel in case where it is already challenged?
See, to a limited aspect, whether it is a service or not is a different thing. I can say it can certainly be a service as far as there is a consideration. If there is no consideration, it cannot be said to be a service under the GST law. This is what my view. I will not go by any stay order given by any of the court because that will not create any issue.
And on the third aspect, they've said that the rule says that where you are a related party and you are liable to claim the credit, then it will be permitted. What if you are not eligible to claim the credit? Say you have some service, your output supply, which is exempted. Then in that case, also this will not apply.
See, I believe there is a fundamental flaw in whole of this circular because what they are treating is this corporate guarantee, which is actually being provided to bank. What they are thinking that there is a person who is a beneficiary, they are treating that beneficiary is the recipient. Whereas in my humble opinion, it is not the case. So corporate guarantee is being provided by the company to the bank, not to the beneficiary. The other related party or etc. person may be a beneficiary of it, but cannot be the recipient, assuming there is no consideration. In that case, it cannot be treated as a supplier under the GST law. And in my humble opinion, both the circular, this one and the earlier one, are not in line with the legal provisions.
Right. So the fundamental aspect itself that who is the recipient. So
Yes.
all the way they have been treating the subsidiary itself as a recipient.
Just one question. The corporate guarantee is always triggered because the subsidiary wants some loan or some funding from Indian bank, and at their request, the guarantee is issued by the overseas parent. So, wouldn't that make the Indian subsidiary as recipient and not the bank? Bank is the agency who is getting the guarantee, but it is for the subsidiary who has asked it for. So, and in many cases, subsidiary do make payment of this money commission to overseas parents also at times. In that case, subsidiary would indeed be the recipient and not merely the beneficiary, to my mind.
I would be humbly, I'm not in line with this particular point because see, all the three parties, let's say there is a foreign holding company, there is a banker in India, there is a subsidiary company. When this guarantee is given, actually all the three are the parties to the case, and all three's business interest is there. Maybe if you talk from the bank point of view, bank is interested in distributing the loan. Many a time bank approaches to the client. It is not only that, okay, we will provide you loan, something like this. If we talk from the holding company point of view, holding company is interested in expanding its business in the country. Similarly, the subsidiary company's business interest is also there. But can we go by this interest or we will go by the documents? So ultimately, the document says if you go through by the corporate guarantee document, the services are being provided by the guarantor to the bank. This is what the corporate guarantee agreement says. And if you'll take the legal provision, if you refer to the Contract Act, that also specifically talks about that who is giving guarantee to the other person. If you refer 126, etc., they will clearly says the clear inference would be that the guarantor is the person who is a service provider. Service recipient, that means guarantee recipient, is the person. This is assurance services precisely. Is the person, is the banker in our case. But there will be a deviation if there is any specific provision under the specific law. Specific law is GST Act. GST Act specifically defines who is recipient. If a person who is the person obliged to make the payment. But in our case, there is no payment. If payment is not involved, then clause A and clause B of the recipient definition will not trigger. Then clause C of the recipient definition under the GST law specifically says the person who has actually received the services. If I read definition of recipient 293, it clearly says where no consideration is payable for the supply of service, the person to whom service is rendered. So we'll come back directly again on this contract acquisition to whom the services are being rendered. Even circular also uses the loosely this term that these services is provided by the holding company to the banking company, which is clear inference that services are being provided to the bank only. That's it. There is no question that the recipient can be said to be a subsidiary company or the person for whose benefit the guarantee is being given. That's it from my side.
Yes, sir. And yeah, in circular, the first question itself in the answer, they have said that the recipient is a banker. So that would also infer that the recipient is the banker itself. So now the circular is driving the wave to the other side, because everybody are now, when we get a notice, we are all challenging that there is no corporate guarantee or there is no service provided. But if we challenge that the subsidiary is not a recipient in a case where there is no consideration paid, if the consideration is paid, then fine, the consideration is paid and that will be the value. But in case where consideration is not paid, then the challenge or the defense should be that you're targeting a wrong person. It should be the recipient who is the banker. That would be the argument.
Correct. Absolutely.
And one more thing, in case of RBI circular, there is a condition or there is a limitation that one cannot pay the guarantee commission. That is basically a condition imposed by the RBI. In that circumstances, suppose the recipient, who is a related party, doesn't pay any consideration for the services. In that scenario, would it be merely a GST invoice kind of thing, and there is no actual payment or actual consideration being flowed? Only we have to raise the GST invoice and GST compliance has to be made. That's it, or no accounting treatment, no payment, nothing. What would be the scene in that scenario?
So to my view, I think that restriction is there only for a director commission. So that a director gives any personal guarantee, there the RBI circular says that a director cannot get any commission. That's why on the director's guarantee, there is no GST implication. But
is that specifically for director or?
Yes, only for director, sir, not for corporate guarantees.
Are you sure for that?
Yes, sir. The earlier circular 203, if I'm not wrong, 202 or 203 clarifies this clearly.
Okay, perfect.
Deepak ji,
Yes, sir.
I wish to ask you one thing. When we read Rule 28, Sub-Rule 2, it says the amendment per annum has been introduced after the words of such guarantee offered. I want to understand whether this per annum for the guarantee or it is per annum for the valuation to be calculated every year. Because when we read the sentence as a whole, it says value of supply of services shall be deemed to be 1% of the amount of such guaranteed offered per annum. So does this want to say that guarantee which is offered per annum, for that only this valuation rule is applicable? Because if per annum word is inserted after 1%, then it would have applied that for any guarantee, 1% would be the value per annum. But here it sounds like that, I don't know, intentionally or unintentionally, but this rule sounds like that guarantee which are offered per annum, for that only this valuation rule is applicable. Can you please throw light on this?
So your placement, you have a good observation that placement of per annum at 1% per annum or guarantee offered per annum makes a lot of difference. Here with the present thing, we don't know the background of it, but let's see that if this is the correct thing, shall be deemed to be 1% of the amount of such guarantee offered per annum, right? Would mean that whatever guarantee I'm offering, if the guarantee is offered for 5 years, then it will be 1% into 5. Vis-a-vis, had it been, shall be deemed to be 1% per annum of the amount of guarantee offered, then you would read that it is for the first year itself. Right? Because when it says shall be deemed to be 1% of the amount of guarantee offered per annum, which means you're offering the guarantee once and then it will be 1% for every year. So that interpretation might be against us, is my view, because when it says that of the guarantee per annum, which means if it's a guarantee is continuing, then for the term of that guarantee, you will have to pay.
Okay, so you want to say that even if guarantee is given for a continuous period of some years, then also you will apply this considering that guarantee as per annum.
Correct.
What about the non-corporate guarantee? I'm not talking of any personal guarantee of director. I'm talking of non-corporate guarantee, like guarantee given by some partnership firm or like that.
So this is specifically on corporate guarantee because 28(2) specifically uses the term providing corporate guarantee. For other cases, then you will have to fall back to 28(1) and go with the open market value. Venu sir has asked a question, what about performance guarantee? I think when there is a specific rule and it says only for corporate guarantee, then we will apply this for corporate guarantee. For any other guarantees or any other kind of supply between two people who are covered under Schedule 1, you will have to fall back to 28(1) for that purpose.
And for which there wouldn't be any open market value. Let's say Reliance Industries says that my subsidiary will execute one road construction contract. And in case if they fail, I will ensure that we will deliver it. Basis that letter, Karnataka government allotted one small tender of road construction.
Okay, so open market value is not there, then we will fall back to other valuation rules wherein cost plus 10%.
And there wouldn't be any cost to it. I only just gave my word. I am not supplying anything to them.
Okay.
So,
So,
but
Deepak
bank
ji,
normally.
Deepak ji, as
Yes.
far as I remember, you at the beginning of your session, you have said that this valuation rule is providing the value per annum and there is a confusion whether it will be continuing services or not, right? So for that purpose only, I want to understand the implication of this word per annum, because still I'm not concurring with your view. Because if you say 1% per annum of the amount of such guarantee offered, and you are saying that 1% of the amount of such guarantee offered per annum, both are giving us same meaning. But what I feel that here we can contest that 1% of the amount of guarantee, such guarantee offered per annum, mean that it should apply only to those guarantees which are offered for per annum purpose. If guarantee is offered for a number of years, then how this provision will be applicable? Because I don't think that that provision can be applied effectively in that case.
Right. So I'm not saying both will have the same impact. Had it been that 1% per annum would have been mentioned shall be deemed to be 1% per annum of the amount of guarantee offered, then what you're saying, I would concur with your view. Now, I am of the view that since it is the word per annum is after the guarantee offered, then you will have to apply each year. Of course, there's a confusion. That's why I'm saying that there are two views possible. That
because when guarantee is given for a number of years, then we cannot break it for per annum purpose, because guarantee offered has to be seen that for how many years guarantee has been offered.
That's true. So we are not breaking up. We are saying that we are trying to depute the meaning for the terms which is used in the law.
Yes. Okay.
No, Akash, here there is a view that per annum would mean that the time of supply will occur every year. It will be a recurring payment. But the counter view that we are having is that can a rule define a time of supply? So that is again the challenge. Because one view is that per annum isliye laya gaya because there was this representation made by many of the bodies that whether we need to pay this guarantee once or every year whenever there is a renewal of the loan, we need to make this payment. Because everywhere there will be this, reaffirming this bank guarantee. So that's why
Right.
it is mentioned here that per annum. But again, we have to see whether it is at all possible that a rule can impose a time of supply provision.
Perfect,
Yeah,
perfect, sir. I also
right,
endorse that view, but
Arupta.
I simply want to raise a point here that per annum has been introduced, but I think it is not introduced at the right place. So it is giving some different meaning. That's what my point is. I truly
Yes.
concur with the view of yours and Deepak ji, but this is what I wish to indicate here.
Yes.
Fine, sir.
Per annum, one more query. Should we raise the invoice upfront or should we wait for the year to close and then raise the invoice? Suppose I want to comply with the circular.
That is also open, sir. They have not mentioned, is it beginning of the year?
Beginning of the year, no. Only let's
No,
say
thing
I
is,
take
if TOS fails, then that could be another way in which the levy should fail. So a vague TOS, I think, will be hit by Govind Saran.
No, but if the loan is given, let's say July 24, every year of July 24 wouldn't be the time of supply? Beginning of the period?
Venuji,
That's
I
when,
agree, it could be. But thing is, unless it is specific, can something that is so fundamental to the levy be vague?
In my view, this is not, it will be very difficult to sustain per annum thing. Like Arupta was saying, in a lighter note, it is kind of the things that revenue has jumped onto into it because there were many discussions in webinars, seminars, do we have to pay it per annum or is it one time? So revenue jumped onto it. Okay, industry is willing, they are discussing whether to pay it per annum. Let's clarify that it is to be paid per annum. There would be addition to revenue. Otherwise, it's difficult to sustain this part in my view. Unless and until it is renewed every year, there is something like that, or that it is difficult to.
Sir, usually in a guarantee form, they do not mention how many years, no, sir.
What I'm trying to say is that we should be very careful in our webinar seminars, at least where they are available in public domain. If it is within this flow of discussions, we can discuss anything. So in public domains, even revenue is listening and they push in things like this. And they are going to get some revenue out of it. Till the time it gets challenged or anything else, they'll add to their kitty. So I've been holding this view earlier also. I discussed personally with Arupta also that like this, say these SMS, should we load the YouTube videos available to everyone? So my view is no. If we are having close discussions within our faculty members, they should not be publicly displayed. But that is besides the point. This was just on a lighter note. Coming to this thing particularly, in my view, it is difficult to sustain this.
Okay. So the question on per annum, there could be
Yes.
two views possible, that if I have taken a loan in, say, in the say in the middle of the year, say on the 1st of June, then 1st of June can be triggered as the time of supply till the next of the June, and then every June you do it if you want to abide, if you're strictly abiding by this. Of course, this will be challenged by various views, what we're seeing. But if we want to strictly abide by the rules and say that, yes, I agree to it, then you will go from the date of the loan itself.
Can the recipient take the full credit, or he has to take the credit proportionately?
So for services, receipt of services there, and he's satisfying those conditions, so then he can claim the credit once he receives the invoice. Correct. It's deemed to be received when it's full. Fine, sir. So I think this discussion will go on, because definitely there are arguments saying that, yes, should you challenge the rule itself, saying that the rule is not correct, to conclude and to go to the next point. One is challenge the rule itself. Secondly, practical difficulties of time of supply, because time of supply do not coincide with what the rule wants to say. So, and the per annum quantum and the percentage saying that 1% per annum or corporate guarantee offered per annum. So these are the things which can be challenged. So let's proceed to the next aspect on interest on late payment of tax.
Deepak sir, one query on this.
Yes, sir.
Sir, as Renu sir told with respect to performance guarantee, can't we take commission that a bank normally charges for the guarantee be the basis whenever guarantee is offered between the group concerns? Wherever Rule 28.2 is not applicable, and when we go back to Rule 28.1, where the open market, as we discussed, there is no basis for open market value. But in the same scenario, when a bank offers bank guarantee, be it performance guarantee or financial guarantee, when it offers to any person, they do normally charge commission. So can't that be the basis for open market value is my question.
But Venu sir was saying that when I give a performance guarantee for something and I don't have any kind of a liability or I don't have any kind of cost to be incurred, what happens in that case? Yeah, I was saying, yeah, open market value. If you have some information like what you're saying to substantiate that if I don't give and if a third party gives it, and if that data is available, then that can be definitely be a open market value.
The same thing would apply wherever there is a non-corporate guarantee. One of the learned member raises a query regarding non-corporate guarantee.
See, it lands
then
up to
we go
open
to Rule
market.
28.1. Yeah.
Correct.
And alternatively, if we are not able to get there is no cost and we are not able to value it, then we can say that valuation mechanism fails and there should not be any tax. BC Srinivasa Shetty, something like that we can develop as an argument to my mind.
That'd be really far-fetched, but definitely, see, there is a valuation, you're not able to determine it. So some determination, once the officer does it and he comes it, then the challenge will be on the mechanism of valuation, right? So we are not able to decide the valuation. So the question will then change to whether that valuation is right or wrong, instead of saying there is no valuation at all. Okay, so I think that will be a little a very far-fetched argument. Then the question itself would change that, yes, if the officer is saying that, no, I will levy 1%, then we will argue, no, 0.5%. So that the discussion goes on to a different tangent itself. Okay, so we left with some 10-15 minutes. I'm sorry, I'll change the gears now. From corporate guarantee, we'll move to the interest on delayed payment of tax. Now, what they're trying to say is the amount what is available in my cash ledger on the due date, that can also be considered for the purpose of levy of interest. So I'll take a case scenario so that we can understand this with dates and numbers. Now I have to make a payment of my GST return. I have to file my GST return for the April month. The due date we know is on the 20th. Now I'll take few scenarios. April month's period, supplies for the month of April, I'm declaring in April. The amount of output tax is 10,000 rupees. I've filed it on the 1st of June. Okay, so there's a delay from the 20th May to the June. I have a balance in my electronic credit ledger of 6,000 and I have a balance in cash ledger of 8,000. So 88B1 says that when you delay your return, your interest has to be paid on the net value, definitely not on the gross value. So you will pay interest in this scenario on the 4,000 rupees, because that is where you are paying your tax through the cash ledger. Now let's take the scenario post this amendment, wherein it's saying that April month's returns, April month supply you have declared in April month. Now the value is 10,000. You will not see for the purpose of this giving effect to this proviso, you will also now see what is your balance in your electronic cash ledger. So that's why I brought in now saying that what was my balance in my cash ledger on the 20th May? It was 7,000 rupees. And on the 1st June, after payment of taxes, it reduced to 1,000 rupees. So in this scenario, on what value will I pay interest on? According to me, since I had balance in the electronic cash ledger on the due date, then there will be no interest liability to be paid, because the provision now says that if on the date of due date, I had sufficient balance in my cash ledger, then interest is not payable. Let's take another scenario. April returns, I had liability of 10,000, balance again in electronic credit ledger, I had balance of 6,000, electronic cash ledger 4,000 is payable. Balance on the due date was 2,000 rupees, and on the actual date of filing, it is 5,000 rupees. In this scenario, what will I pay interest on? In this scenario, I think it should be payable on 2,000 rupees, because the cash balance I had 2,000 rupees, right? On the balance of 2,000 is what I have to pay interest on. Now, the third scenario will become a little interesting, where March month's sales, I have declaring it in the month of April, and the liability for that sale. I'm not saying the, say, assume a situation where April I have not made any sale. March month I've made a sale, but I've not reported in the month of March, I've reported in the month of April. The output tax payable is 15,000 rupees. I had electronic credit ledger balance of 10,000 rupees. Electronic cash ledger, I have to pay 5,000 rupees. And the balance in my cash ledger is 7,000 rupees. And in this scenario, what will be the interest liability on? Will it be on nil value because I had sufficient electronic cash ledger balance, or will it be something else?
Should be nil in my view.
Okay. So here I want to bring in a distinction between 88B1 and 88B2. Okay. Because the proviso which has been inserted is inserted to 88B1. And the scenario of 88B1 covers a sale where you have declaring the returns of this month in your return for the current month itself. In any other scenario, it will always be payable on the gross liability. So if you foresee 88 distinction between 88B1 and 88B2, you would see that when you're disclosing the sales of the prior months in this month, then this benefit you will not get it. And in my view, it will be on the whole 15,000 itself, and not even on one view is 0 on the zero, the interest will be 0. Another view can have that electron on whatever you're paying through your cash ledger will apply, but the right position according to me is on the whole value itself. I just wanted views whether if you see the last scenario, is my view correct or no? I think it's important we populate 88B2 to understand this.
Deepak, rule is not visible. Only the example is visible.
Yeah, I'll just share. Yeah. So 88B1 says that in case where the supplies made during a tax period are declared by the registered person in the return for the said period, and the said return is furnished after the due date in accordance with the provisions of section 39, except in case of 73 and 74, the interest on tax payable in respect of such supplies shall be calculated on the portion of tax which is paid by debiting the electronic cash ledger for the period of delay. And now there is a provision which says that where any amount has been credited in the electronic cash ledger as per the provisions of 49 before the due date, but is debited from the said ledger for the payment of tax while filing the said return after the due date, the said amount shall not be taken into consideration while calculating such interest. So this proviso is specifically for 88B1, and 88B2 says in all other cases. So in all other cases would mean a case where is different from 88B1, which is supplies made during a tax period is not declared in that tax period. In that scenario, 88B2 will kick in, and it will say that interest is payable. The interest shall be calculated on the amount of tax which remains unpaid. So from this distinction, I'm saying where you disclose previous month's sale in the current month's thing, then the interest will be on the gross tax payable.
So as the invoices of March are reported in the April GST are 3 weeks. So that's why you're saying the interest is arising, right?
Correct.
Yeah, so that will be there. Yes.
So no benefit out of this provision can be taken in case where suppose the challan is paid on 25th of April and the return is filed say 15 days late because the client failed to inform that the challan has been paid. But the original challan is paid 5 days late and there was no balance as on date of filing of return. Due date of filing of return.
Yeah, so no, that is I think clear. They want two things. One is as on the due date, the balance should be there. Secondly, the balance should have been debited while filing the return. So these are the two conditions that have been given for this. So if we pay the tax after the due date, so we don't get this benefit. But if we have this in the balance and later on we don't adjust the cash somehow and we adjust, the credit ledger in excess, so that will also be not be allowed. So those are the situations.
So we need to tell by default, keep depositing some money in the account. You know what is net flow, outflow, keep that there.
Yes, so that is the actual thing that they want.
But is that the intent with which this amendment has been brought in, or it is just a drafting error or the error of placing the proviso here instead of at the end of the entire section?
So if you see Eicher Motors, so this was the main contention that we had the balance in our account, cash ledger on that date, and in spite of all that, why should I pay the interest? So I think that has been only carried out here through this amendment. So if the balance is not there on the date of the due date, so giving that benefit would be, I think, is not the objective of this particular amendment. And again, another aspect to this is what was challenged in one of the other courts is that maybe because I'm a works contractor, so I could not pay the full amount. So 1 crore is payable in cash, but I had 60 lakhs. So I've deposited 60 lakhs into the cash ledger. So why should I be punished even for that 60 lakhs where I've already deposited that? So I should pay interest only on the remaining 40 lakhs, which I could not deposit. So I think keeping these 2-3 views in mind, I think this amendment was passed. I think there was somebody else. Yeah. Somebody else wanted to share the view. I think I just.
Deepak, it's 10. Just a time check.
Yeah.
Oh, achha. Yeah. So any other final views on this?
I think Aurubji, you are very right in that. The intent was that whenever the balance is available in the cash ledger, there should be no liability, at least on that part, which is maintained in the cash ledger. But the amendment which has been done in the rule is not with that same intent, but only to benefit those people who have deposited on the due date only.
No, Ramandeep, I beg to differ here. The word used is available.
Correct.
So even if I have from my GST TDS, I
Yeah,
get
yeah.
a credit. Even that is also there. If this
Right,
balance
agreed.
is available,
Right,
Yeah,
sir.
yeah,
Agreed.
yeah. So
So
that
on the
is
due date, if you have balance available, then only the benefit will be available.
yes, only then.
But let's say if a person has deposited after the due date and a portion of it, a part of it, and then again
then
a
that
next
benefit is
part,
not there. Yes.
yes, that is not the intent, right? Yes.
That is not there.
Yeah.
So we may look for a clarification or amendment in that rule to that aspect, because I think that's what is missed out. Okay.
True, sir.
True, sir.
We'll write for them to issue one circular.
Then we'll discuss it in SMS. I think it's 10 o'clock. So I think Deepak ji, your final views, and then maybe we'll have a closure for the day.
Yes, sir. So those two aspects, I think first part we have already clarified. On second aspect, on the interest portion, that yes, I think the placement, I feel that the intention was to give the benefit to people who have already deposited, have a balance in the cash ledger, and then they don't want to suffer interest for whatever reasons. They have filed the return late. So that was the main intention. It looks like till now. But of course, for part amount where I have part amount and have debited it later on, that there is no clarity as yet. So that we will look out for. Yes, sir. So we have other points for discussion in the notification on GSTR 1A. I think in the next session, we should be taking up GSTR 1A and the impact of it.
So next session, we'll complete the changes that have been there, because then in the next session, after that, we need to discuss about the budget amendments, which are coming. So, Unniji, over to you for vote of thanks. I'm not sure whether Unniji is connected.
Yes,
Unniji, are you connected?
Yeah. Thank you, Deepak sir, for a very enlightening session on the recent circulars. Now, your session has exposed the vulnerabilities of these circulars, which every one of us can now make use in their litigations across the board. Now, you have also left us some serious questions that we need to think about, so that we can have a further discussion at a later point of time. We also see that even in the smallest details, such as those in the interest, we have a possibility to write to the government to clarify the position in light of Eicher Motors and other factors, to make the law much more friendly for those who have actually paid the tax and that for which an interest levy may not be possible. So all these could not have come up unless you had researched a lot and put up in your hard work, so that it has enriched all of us. So on behalf of everybody here, I extend a hearty congratulations as well as a very deep gratitude for offering your time on a busy Saturday morning. And I thank all the members for participating, because your participation is also very important for making the SMS what it is today. So for the next sessions, we'll continue with the other subjects as we'll decide later on. And again, on a parting note, I encourage everybody to stand up and take up a session and take up a topic of your convenience, and you can inform us and we'll schedule it accordingly. Thank you all. Have a good Saturday morning.
And thank you, and request all of you to inform other members to also join the SMS, encourage them.
Thank you, everyone. We'll close the meeting today and have a wonderful weekend ahead. Thank you. Thank you very much.
Thank you all. Thank you. Bye.
Thank you. Bye. Bye.